Group Statements, Chapter 7, Value Adjustments. In this chapter, we will look at the influence of at-acquisition value adjustments on the consolidation process. At acquisition date, a parent obtains an interest in the net assets of a subsidiary. Net assets equals equity through the accounting equation. IFRS 3 business combinations is an accounting standard that regulates the at-acquisition date of a business combination. In terms of IFRS 3, all the subsidiaries' assets and liabilities must be recognized at fair value in the consolidated financial statements at the date of acquisition, even if it's not measured at fair value in the separate financial statements of the subsidiary. But why is it important that the net assets of S are fairly valued at acquisition date? First of all, the cost of the investment by P in S, in other words, the consideration that P is willing to pay for his investment in S, will be based on the fair value of the identifiable net assets of S at acquisition date. Then that fair value of the net assets of S represents the fair value of the business of S. Goodwill or gain from bargain purchase is calculated as the difference between the consideration and the measurement of NCI at acquisition date and the net assets of S. Again, if the net assets of S is not fairly valued, you will end up calculating an incorrect goodwill or gain from bargain purchase. NCI in the ordinary shares is measured at either fair value or their proportionate share of the net assets of S. If the net assets of S is not fairly valued, you will end up having an incorrect measurement of NCI. Therefore, the fair value of the net assets of S at acquisition date influences the correct measurement of the investment by P and goodwill and gain from bargain purchase and NCI. If the net assets of S change, your at acquisition equity of S will also change as a result of the accounting equation. And that will lead to a change to your at acquisition consolidation journal entry. If the carrying amounts of the assets and liabilities of the subsidiary at date of acquisition are not equal to their fair values, the carrying amounts should be adjusted. These value adjustments could be necessary with regards to any asset or liability, including depreciable and non-depreciable property, plant and equipment, investment property, and inventories. These adjustments to the values may be recognized in the subsidiary's own accounting records. In such a case, no further or very limited adjustments will be required for consolidation purposes. However, the subsidiary may make such an adjustment only if its own accounting policy in its separate financial statements allows it. For example, an adjustment to the value of the property, plant and equipment would require the subsidiary to apply the revaluation model of IAS 16 property, plant and equipment as its accounting policy in its separate financial statements. If the subsidiary does not recognize the necessary adjustment in its own accounting records, the adjustment will be done by way of a consolidation journal entry. The consolidated financial statements will, however, be identical at date of acquisition, regardless of whether the adjustment is processed in the subsidiary's own accounting records or only as part of the consolidation process through consolidation journal entries. If the subsidiary does not recognize the necessary adjustment in its own accounting records, it will lead to differences between amounts recognized in the separate financial statements of the subsidiary and the amounts required for consolidation purposes because of IFRS 3. These differences need to be identified so that the necessary consolidation journal entries can be recognized for these differences. Remember, the totals and balances recognized in the separate financial statements of both the parent and the subsidiary represent the starting point of the consolidation process. This is where we take 100% of B and add to that 100% of S. That is my starting point. After these totals and balances have been added together, it has to be adjusted for the effect of any consolidation journal entries before we can conclude we have faithfully represented group statement amounts. The following work method is suggested to identify these differences. This column represents the actual measurement of the asset in the separate financial statements of ACE, the TB of ACE. This column represents the fair value measurement amounts relating to the same asset for group statement purposes required by IFRS 3. Any amounts in the differences column indicate that the amounts from the trial balance of ACE have to change to represent the required amounts in the group statements. For all differences identified, consolidation journal entries are required. In other words, the first column represents your starting point, the trial balance of ACE. The second column represents what the numbers should be in the group statements. To change your starting point to represent what is required in the group statement numbers, you will end up having to write consolidation journal entries for the differences. ACE's own accounting policy, coming from the application of IAS 16 and IAS 40, will influence the action by ACE at acquisition date, and this will consequently influence the required consolidation journal entries. There are 3 possible scenarios that will be covered through the examples in Chapter 7. Scenario 1, ACE will adjust the carrying amount of the assets in its separate financial statements before consolidation. Scenario 2, ACE never adjusts for the value adjustment in its separate financial statements. And scenario 3, ACE does not adjust at acquisition date, but does value adjust later. The following structure organizes the examples in Chapter 7 under the 3 possible scenarios.